Welcome back to the Deep Dive. Today, we are taking a high-speed shortcut into the world of elite finance. We're cracking open the real estate blueprint of, well, one of the world's most successful figures, Michael Bloomberg. We all know the name, the terminal, the $106 billion net worth. But the sources we've gathered reveal something really crucial. His massive property portfolio isn't just a collection of nice places to live.
Not at all.
It's an actively managed, highly strategic asset class that has profoundly contributed to that wealth. So our mission for you, the learner, isn't to just marvel at the cost of a Manhattan townhouse. It's to synthesize the accessible, the applicable principles behind all this success. How does a billionaire manage property, and how can those strategies, scale down to help you acquire and hold value?
That's the core insight here, I think. What's so fascinating is that this level of success, it relies on these sound universal strategies. They predate any specific billionaire. Bloomberg's team didn't invent these ideas. They just executed them with extreme precision and a lot of capital efficiency. We're looking for those universal mechanisms.
Okay.
If you strip away the nine-figure price tags, the whole investment strategy, it really just boils down to a few core actions. Actively increasing value, practicing some profound patience, and focusing relentlessly on future demand.
Okay, let's jump straight into that first one then, that first mechanism. It's about active intervention, or what professionals call forcing appreciation.
Yeah.
This isn't passive ownership at all. It's making the asset inherently more valuable through direct action, upgrades, expansion.
Precisely. Passive appreciation relies on luck or maybe broad market trends. Forcing appreciation means you control the timeline.
You're in the driver's seat.
Exactly. And you can see this in the source material, like his Upper East Side townhouse acquisition. It wasn't just a single transaction. It was an assemblage. He bought adjacent properties and then followed that with years of meticulous high-end renovation and strategic expansion. The goal of that kind of move, and it doesn't matter if you're combining brownstones or just adding a bathroom, it's always the same. Maximize the asset's utility and its potential income stream.
But when we talk about forcing appreciation, what's the core financial driver? I mean, for someone who owns just a small rental property, is the goal just to get a higher appraisal, or is there a deeper lever?
Oh, it's absolutely deeper than just aesthetics. The goal is to raise the net operating income, or the NOI.
The NOI.
And that directly impacts the capitalization rate, or cap rate. So look, if you can spend, say, $50,000 on renovations that let you raise the rent by $500 a month, you are fundamentally increasing the underlying value of the asset. And it's far beyond the cost of that renovation itself.
Okay, so you're not just getting your 50 grand back.
Not at all. This also drastically changes your position with lenders. By increasing the appraised value, you improve your loan-to-value ratio, your LTV, which can then allow you to pull cash out via refinancing tax-free to fund your next investment.
And that's the billionaire mechanism.
That's it, using the first property to fund the second.
Okay, that makes it so much more actionable. So for the everyday investor, it's not about choosing the fanciest tile.
Right.
It's about choosing the renovation that gives the best boost to the NOI or LTV.
So what are the highest yield options we see in the sources?
The sources confirm two main areas yield some tremendous returns for single-family homes. First is utility. So modernizing a kitchen or adding a functional bathroom, especially converting a half bath into a full bath, that just widens your pool of potential buyers or renters substantially.
Sure. You go from appealing to couples to appealing to families.
Exactly.
Yeah.
And that market is willing to pay a premium. The second area, which is increasingly a game changer in dense urban or suburban areas, is focusing on sustainability and efficiency, like solar panels.
Could be, but even simpler things like adding energy-efficient windows, updating HVAC systems, or installing smart home tech. It doesn't just reduce utility costs, it positions the property as future-proof. Buyers are actively seeking those features now, so it's become an essential local market demand.
So we're renovating based on the next buyer's demand curve, not on our personal preference. That makes perfect financial sense. All right, let's transition from active spending to something that's maybe much harder to master. Strategy 2, the power of patience.
Yes. And this is where real estate fundamentally differs from, well, almost every other investment class. Real estate operates on a decade-long cycle. And we see this so vividly in the portfolio, specifically with the example of the Armonk, New York property, acquired for a very modest $375,000 way back in 1993.
93. Wow.
Yeah, that wasn't a quick flip. That was setting the clock for 3 decades of compounding.
I find this really challenging because we live in such an instant gratification economy.
Uh-huh.
If I invest, say, $5,000 in a stock market ETF, I can see my returns daily.
Yeah.
I buy a property. I face high transaction costs, interest, property taxes, all before appreciation really even kicks in. So how does this long game translate to value for the learner who might need liquidity or returns sooner?
Well, that difficulty you just described, that's precisely the barrier that filters out unsuccessful real estate investors. The long game works because it allows you to fully utilize debt and leverage. For wealthy investors, this patience is often coupled with very sophisticated tax strategies.
Like 1031 exchange.
1031 exchanges, exactly. They allow them to defer capital gains tax indefinitely by rolling profits from one sale immediately into a like-kind new investment.
Right.
For the learner, the takeaway is understanding the true cost of short-termism. Flipping often generates ordinary income, which is taxed at higher rates. Plus, you pay transaction costs, commissions, closing fees twice in rapid succession. Holding for, say, 7 to 10 years at a minimum. It means those costs are amortized over a much longer period, and that allows compounding to do the heavy lifting.
And it often leads to better tax treatment when you finally sell.
Lower capital gains tax, precisely.
So the immediate returns aren't the point. The long game allows the passive leverage and the tax environment to actually work in your favor.
Exactly. It's about letting time be your greatest asset. It requires fundamentally avoiding that speculation trap.
So you're saying base decisions on the long-term potential, not the hot trend of the week.
Yes. Don't base them on trends that pop up on investment news feeds. Base them on long-term area potential.
We can actually model this patience. You mentioned using certain tools to help forecast.
Yes, we can. I mean, we can't predict the future, of course, but we can model our break-even point. We recommend leveraging property appreciation trackers and mortgage calculators. They help you determine the specific holding period you'd need to ensure that the appreciation clearly surpasses all your transaction and carry costs. If your analysis shows you need 15 years to hit your financial goal, well, then you have a goal, not just a hope. It turns patience into a calculated variable.
Planning and patience. Got it. Okay, let's move to strategy 3. Location focus. Bloomberg, naturally, invests in premium spots. Manhattan, the Hamptons, London. I mean, areas where demand consistently outstrips supply. But how does the everyday investor distill this wisdom? How do you identify a high-demand location before it becomes prohibitively expensive?
That is the detective work of real estate. For Bloomberg, premium locations act as an excellent hedge against inflation, and they ensure stable rental income, even during downturns.
Because there's always a waiting list to get in.
Always. And these areas appreciate faster simply because the barrier to entry cost, or just physical limits, is so high. For our listener, the key is spotting the signs of future scarcity. You need to look for growth markets that have yet to peak. This means looking beyond the current pricing and analyzing predictive indicators.
Okay, so what are we looking for?
The sources detail a few specific areas to investigate. First, strong job markets are absolutely essential. You want to look for areas attracting company headquarters, research facilities, high-wage employers, because high-income people drive demand for quality housing.
Makes sense. What else?
Second, excellent schools are non-negotiable for families. That provides a tremendous insulation against future depreciation.
And what about the future development side of things? That feels a little risky. Relying on a new transit line being built seems like speculation, not investment.
That's a very valid point. Relying purely on announcements is risky, for sure. But investigating city planning records and public investment announcements, that's foundational, especially for infrastructure like new transit, major parks, or utility upgrades. If the city is spending millions upgrading a neighborhood's core infrastructure.
That signals long-term confidence.
Exactly. And it signals a coming influx of private capital. I often tell investors to check public census data. Look for growth in median household income and educational attainment rates in specific zip codes.
Oh, that's smart.
It tells you who's moving in, and if they have higher spending power, the property values will follow.
So you're using Zillow and Redfin for more than just browsing houses?
Oh, absolutely. You use them for tracking price history, momentum, the ratio of listings to sales, seeing if one neighborhood is spiking while the one next door is totally flat.
That elevates the advice far beyond just use Zillow.
Yeah.
You're using public and proprietary data to predict where future demand is going to constrain supply. Okay, now, let's pivot significantly. We've covered strategies for buying physical property, which, it requires large capital, ongoing management.
It's a lot of work.
It is. So for the listener who finds that overwhelming or who needs higher liquidity, What alternative strategies does the Bloomberg blueprint suggest for accessing the real estate sector?
That's where adaptability comes in. And it's a great point. Real estate investment is not solely about mortgages and tenants. The source material outlines 3 fantastic alternative paths. Yeah. And they provide exposure, typically with lower capital requirements, and a reduced risk profile. The first, which is foundational, is real estate investment trusts. REITs.
Right, REITs.
When you invest in a REIT, you're buying a share in a corporation that owns a whole portfolio of income-generating real estate malls, apartment complexes, offices. And the mandatory requirement is that they have to distribute at least 90% of their taxable income to shareholders.
Which results in high dividend yields.
Very high dividend yields.
Those dividends make them highly attractive for income generation. But does that affect how they're taxed?
It does, and that's a key nuance to understand. While direct property owners benefit from things like depreciation, which can offset rental income, REIT dividends are often taxed as ordinary income.
So potentially less tax efficient than long-term capital gains.
Potentially. The trade-off is high liquidity and diversification. You can buy and sell shares instantly on an exchange.
Right. What's the second option?
The second option is exchange-traded funds, or ETFs, which focus on real estate or even the construction sector. These offer even greater diversification because they're pooling holdings across different regions, different types of property investments.
So they minimize sector-specific risk.
Exactly. And they are also generally considered highly liquid.
Okay, and the last one?
Finally, we have the newest mechanism, the one that has truly democratized access. Crowdfunding platforms.
Like Fundrise or Realty Mogul.
Those are the big ones, yeah. They pull small amounts of capital from many, many investors to fund large developments, a hotel, a commercial strip mall. You can potentially start with as little as $500.
Wow.
The important distinction here, though, is liquidity. While the entry bar is very low, your capital is often locked into the project for its specific timeline, say 3 to 7 years.
So you trade that instant access.
You trade instant access for the ability to participate in these high-yield, professionally managed projects that, were once restricted only to institutional investors.
That clarifies the risk-reward spectrum beautifully. So you've got high liquidity, potentially higher tax rates with REITs and ETFs, or a lower capital requirement but lower liquidity with crowdfunding. It all depends on the learner's own financial structure. So, to recap, we've distilled 3 core principles from this staggering portfolio. Force appreciation through strategic upgrades, leverage patience for tax and compounding benefits, and relentlessly research location potential. The entire blueprint is built on, highly sophisticated planning and adaptability.
Absolutely. The success lies not in the size of the investment, but in the rigor of the plan. Whether you are assembling luxury townhouses or just saving up to add a bedroom, the decision-making process has to be strategic.
Upgrade wisely.
Think long-term and invest where future demand is clearly going. And here's the final, maybe provocative thought to consider. While the size of Michael Bloomberg's investment certainly differs from yours, the source material made one final stark point. The true key is simply to start now. Real estate appreciation operates on a timeline, and every year you wait is a year of compounding that's just lost. So how might applying just one of these principles, whether it's strategically budgeting for that kitchen modernization or committing $500 to a crowdfunding platform, how might that change your long-term financial trajectory? The time to plant that seed of wealth is today.
A profound challenge and a perfect place to leave our deep dive. Thank you for joining us as we unpack Michael Bloomberg's real estate strategy. We hope this knowledge moves you forward. Until next time, keep digging deeper.